Hey everybody, what's going on? It's James here, and in this video, I'm going to talk about a simple concept, and that concept is why long trading is easier than short trading. And the funny thing is a lot of people think that a pattern will work the same way on a bear side that it works on a bull side. So for example, if you have a triangle and it breaks out to the north, people are like, oh, that's a long entry. If you have a triangle and it breaks out to the south, people will think that's a short entry. And that seems to be the common knowledge. And it's the same way that I tried to approach the markets the first few years I was trading as well. And it's not that it doesn't work at all, but there's some key differences between a long and a short. I'm going to talk about those in this video. And I'm essentially going to share why I think for newer traders or traders who are not yet profitable, they should focus on only longs and not shorts. And of course, talking about in this sense of a day trading environment. If you're trading larger time frames, then that changes whether you're in a bull market or a bear market. But regardless of the market type, bull or bear, on smaller time frames, longs are going to be easier to trade. So let's just think about this for a second. If you are talking about trading, and you're talking about new traders especially, if you have a market moving up, and ignore the color, I'm just going to draw these the same color. So you have a market moving up, you have these candlesticks, and it starts to pull back. Greed kicks in, and people will often start buying these pullbacks, okay, looking for that next leg up. And because a lot of people trade the same way, that's what really makes technical analysis work, because it's a bit of a self-fulfilling prophecy. So you have all these people buying here, which of course creates demand. And when that demand outstrips supply, price will move up. Okay. So that's what makes these pullbacks, assuming they're pulling back to some type of support, that's what makes these pullbacks interesting places to take trades. From the short side, then, we would have something like this, right? We'd have the market moving down, 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 and maybe it starts to come back up, something like this. And so why wouldn't it be a good idea to look for shorts here that we could then ride down the next leg? Well, it's not that it's a terrible idea, because you can trade that way, especially on larger time frames, but especially on smaller time frames. Here's what happens. Emotionally speaking, people are way happier to throw money in from greed and ride that up than they are to sell for a loss. And what I mean by that, you might be thinking, what do you mean sell for a loss? If I'm entering position, I'm not at a loss. No, you're not. But see, a lot of these traders over here, watch this. So this pulls back. You have all these traders that are in this trade, right? It pulls back. They're not immediately jumping out of this trade because they're hoping and praying that it's going to keep go up and they can at least get back to break even. Okay. Over here, when this bounces back up, it's the same thing. These people are not looking to sell. They're not getting, this whole idea that the market panics and moves down, 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 right? Sometimes you get a big move. Of course, that's a daily chart. But typically what happens on these smaller time frames is people will not let go of the position. They will keep holding on, holding on, holding on. Even if this starts moving back down, they'll keep holding on, hoping and praying that they can get even before the end of the day. And so you don't get the same momentum on a short that you do on a long. And I don't know that I explained that the best way possible, but essentially there's going to be a lot more people buying, which is why you can count on these moves back up, than there are going to be people selling, because the people selling here are going to be people looking for short trades. But the people that are already in these positions, they're usually not selling these bounces. They're only selling these bounces if they get back to their entry point. They want to break even. There's something psychologically about taking a loss. People just refuse to take that loss. And so you don't have as much selling pressure on a case like this as you have buying pressure on a case like this. And that's the reason that a lot of times when a market does start to move down, what you'll actually see is you'll see the market do something completely different, which I'll show you as soon as I get this crap off the chart. So typically what you end up seeing instead is you see something like this. You'll see a market start to go down, and then it'll start to go up. People get into a short, they get all happy, it starts to go down, then it starts to go up, and then down. And you get a lot of this. You get these ranges, and sometimes it'll eventually crawl its way down a little bit. But it's usually not as clean as something like a pullback, where you get these really clean back, and then up, 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 right? So on and so forth. So let me show you a quick example of this on a 5-minute chart. We happen to be on NEO. No specific reason. This is NEO, the stock, not the cryptocurrency. So we will put it on a 5-minute chart, and we'll take a look at this. Okay, so here's an example of an uptrend, right? Goes up, boom, 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 pull back, boom, 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 and boom, right? Great, simple, awesome trade. Goes down, goes up, goes down, goes up, goes down, goes up, goes down, goes up. I didn't look at this before the video. This is just what happens, right? Here's another one. Big move down, up, down, up, 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 up. See how they turn in the ranges a lot more? Here's another one. So you're expecting to back boom, 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 but that's not what happens. They almost always, well, not almost always, but often they do this. They go down, up, down, up. They just rain. See how like move after move, these just are not clean moves. And again, it just got to do with the emotional side of it. These people that are underwater are hoping and praying this goes back up and lets them out of their position. So anyway, I thought I'd shoot that video today because it's something that I don't see people talking about. I don't know that I've ever seen somebody talk about, to be honest. But if I have, I've forgotten by now. So, it is what it is. But so keep that in mind. Longs are definitely easier than shorts. Longs are typically going to have cleaner trends than shorts are going to have, especially in smaller time frames. When we get into larger time frames, it's a different story, because then you start talking about bear markets and things like that. And obviously, like on NEO during a bear market, you do get big moves down. For example, weekly chart. This is all a log chart, I can tell. See, then you get the big move down. All right. As always, remember that I'm just some guy sitting in a spare bedroom, which means that nothing in this video is financial advice. And you should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable assets. If you haven't already, stop now. Give the video a thumbs up, whether it's on YouTube or Facebook. Make sure to leave me a comment, whether it's on YouTube or Facebook. And as always, please remember to trade safe.